Welcome back. Let me ask you something. Why is it that two people can buy the exact same investment at the exact same price, and years later one becomes wealthy while the other quits, loses money, and swears investing is a scam? Is the market really the problem, or is it something happening inside us?
That's a powerful question. The truth is, investing isn't just a numbers game. It's an emotional game disguised as mathematics. Think about it. When your portfolio climbs 20%, you feel brilliant. You start believing you've figured out the market. Confidence quietly turns into overconfidence. You take bigger risks, not because the facts changed, but because your emotions did. Then the market falls. Suddenly, the same investment you loved yesterday feels dangerous today. Nothing may have changed about the business you invested in. The only thing that changed was the price and your emotions. That's the emotional roller coaster every investor eventually rides. Reflective, fear whispers, sell before it gets worse. Greed shouts, buy more before it's too late. Hope convinces you a losing investment will magically recover tomorrow. Regret keeps replaying the opportunity you missed 6 months ago. Here's what's fascinating. Behavioral finance has shown us that losing $100 hurts far more than gaining $100 feels good. That's called loss aversion, and it explains why so many investors panic during market crashes. Imagine planting a mango tree. Would you dig it up every week to check whether the roots are growing? Of course not. Yet many people check their investment apps 10 times a day, reacting to every tiny movement as if wealth were built minute by minute. Real wealth is usually built in silence. Some of history's most successful investors weren't successful because they predicted every market move. They succeeded because they mastered themselves. They stayed calm when everyone else panicked. They remained patient when others chased excitement. I remember speaking with an investor who watched nearly 40% of his portfolio disappear during a market downturn. Friends told him to sell everything. Headlines screamed disaster. Instead of reacting emotionally, he reviewed why he invested in the first place. His reasons hadn't changed, so neither did his plan. Years later, that same portfolio reached new highs. That story reminds us that markets recover more often than emotions do. Investing is less about finding the perfect stock and more about becoming the kind of person who can stick with a good strategy. The market constantly tests your patience, discipline, humility, and emotional intelligence. Every price swing asks the same question: will you react or will you think? Because the greatest return you'll ever earn isn't just on your money, it's on your mindset.
What a conversation. If this changed how you think about investing, share it with someone who needs the reminder. Subscribe for more conversations on the psychology of investing. And until next time, invest with your mind, not your emotions.